Hello, everyone, and welcome to Fairfield County SCORE's latest live webinar series for aspiring entrepreneurs. I'm Kathy Walsh, a business mentor here at Fairfield County SCORE, and I'll be your host. Our sponsor for today's event is Fairfield County Community Foundation. FCCF is a nonprofit organization based in Norwalk, whose mission is to close the opportunity gap by eliminating disparities in income, education, employment, housing, and health. Fairfield County SCORE is proud to partner with FCCF, and we thank them for their support of our webinar series. This series was designed to support women and minority-owned small businesses. This is the 5th of 7 webinars being done over the next few Wednesdays, each starting at noon. Today's webinar is entitled Financing Your Small Business in 2022, and our speaker will be Joe McCaffrey. More about Joe in a few minutes. First, I'd like to share some brief information about SCORE. SCORE is funded by a grant from the Small Business Administration, so all of our services are completely free of charge. There are about 300 SCORE offices in the U.S. with over 10,000 volunteers. Fairfield County SCORE is one of the largest and highest rated chapters in the nation, with over 100 volunteers comprising a wide range of expertise. We offer 3 value-added services to small businesses, which are all accessible from our website at fairfieldcountyscore.org. First, we provide free one-on-one counseling through face-to-face meetings, telephone calls, email, and video conferencing. Second, we produce over 100 educational workshops and webinars each year on topics of relevance and importance to small businesses. And third, we have extensive resources and tools on our website, including templates to help you build your business plan. So this is a special webinar event because there's an opportunity for participants to earn a grant at the conclusion of the series. We will be giving away $2,000 grants up to 10 contestants. And judging for the grant awards will be based on presentation of your business plan. So you will all be receiving, if you haven't already, via email, since you've registered, you're going to see the instructions and more information about the grant. And then you have this 10-page business case analysis. Please fill them all out. The deadline will be June 28th for submittal, and then the judging, I think the 28th, and then the judgment will be somewhere around July 5th. So, hang on one quick second, let me just check the date, 28th or 29th. Oh, I'll circle back on that one. All right, so the object is to sit down and think about your business, and constructing a business plan can be a pretty difficult task. So in order to help you figure out what to write, do the business case analysis, and then send it back into us. Remember, you're in business for yourself, but not by yourself. SCORE mentors are available to help you complete these documents. And I encourage you to take advantage of the opportunity to collaborate with them. Ultimately, what the judges will be looking for is a synopsis of what we call your story. Tell us in the fewest words possible what is so great about you, your product, your service, and your business. Essentially, this will be an executive summary of the business case analysis and financial projections, and will serve as the basis for your presentation. You'll have a limit of 1 page to tell your story, so make it good. This is your elevator pitch. The files for the business case and financial projections, as I said, will be emailed to you. So let's get started with today's event. If you have questions during the webinar, please use the chat box located at the lower part of your screen. To respect your time, our webinar will end promptly at 1 p.m. This session is being recorded, and a link to the recording will be available at fairfieldcountyscore.org within the next few days. Now to our speaker. Joe McCaffrey is a business advisor with Community Investment Corporation, which is a not-for-profit economic development lender, licensed by the Small Business Administration to administer their lending programs. Joe is also a certified business mentor and subject matter expert in commercial real estate and small business financing with Fairfield County School. Today's workshop will provide you with information on how to assess your financial options and how to prepare you most effectively to engage with potential lenders. And with that, Joe, take it over.
Thanks, Kathy. Good afternoon, everyone. It's nice to be with you here with you all today. Let's get right down to business. Okay, that's me. I'll talk more about Community Investment Corporation a little later. Let me start off by saying this presentation contains a lot of information. I'm going to go through it pretty quickly. Today's session is being recorded, as Kathy said, so if you miss anything, don't worry, you'll be able to go back and replay it. This webinar is similar to a presentation I did for SCORE back in March, but I changed it quite a bit and added a lot of new material. So don't doze on me if some of it sounds familiar. I will address your questions at the end of the slideshow. If I don't get to all your questions, we can continue the discussion later. Feel free to call me or email me. My contact information will be given out at the end of the session. Okay, so today we're going to talk about money, and more specifically, how to get money for your small business. For most people, the primary reason why they're in business is to make money, unless you're a nonprofit, social enterprise, or what's called a benefit corporation. If you're interested in learning more about what a benefit corporation is, reach out to me and I'll send you a white paper I wrote on Connecticut benefit corporations. So what sort of things does your business need in order to produce revenue? Well, you need something to sell, like a finished product, or if you're selling a service, you need to develop expertise. You might need some equipment to make whatever it is you're selling, customers, might need to do some marketing, physical presence, website, social media profile, some employees, maybe a license, depending upon what type of business you have. The most important thing that you need, however, is you need money. Okay, you need money in order to make money. Money helps to pay for all the things that your business will need in order for it to make money. Folks, I'm here to tell you there's no such thing as starting a business with no money down. It doesn't matter what you do, you're going to need money. Okay, and if you're a startup business, it's not easy to find money, and whatever money you do find, it's usually expensive. I tell people who need money, access to capital is more important than the cost of capital. Nevertheless, I'm going to show you how you can find relatively inexpensive sources of capital. So where do you go to get money for your business? The reality is it's difficult, but not impossible to get money for your small business, especially if you're a startup. Starting a business is very risky. That's why hardly anybody wants to give you any money. It's that simple. There are two sources of money that you could potentially look for here: your money and other people's money, OPM as we call it. The latter is generally what most entrepreneurs prefer, but let's start with your money. This is where you're going to go first. So what sort of things can you get money from? Obviously, any cash and cash equivalents. This might include bank accounts, CDs, maybe cash value of life insurance. If you have anything left in your crypto account, maybe not. If you have any investment accounts like stocks, bonds, mutual funds, basically this includes anything liquid that you can turn into immediate cash by selling it. Maybe retirement accounts you can liquidate, but you may incur taxes and penalty fees if you're not of the appropriate age. Do you have any personal assets like a car, truck, boat, motorcycle, house, artwork, collectibles that you don't need? Maybe you can sell some of those. Think of it this way: you're just trading one asset for another. Your business is an asset, and one that will hopefully grow in value just like any other asset. Maybe there's an inheritance advance that you can get. I know people who've done this. They go to their parents or grandparents and ask for an advance on inheritance. In some cases, they've gotten it. And there is occasional benevolence that you can get from people who have a vested interest in your success. This might be a loved one, a family member, oftentimes parents, in-laws, grandparents, those sort of people. They might be able to give you money to get your business going. In terms of private loan sources, this is what I call the alternative lending market. I'm going to go through these just quickly. Friends and family loans, this is a good way to see, who believes in you and your business, but can harm the family relationship if the business goes south. So, just be careful about that. You can try to get or if you already have a home equity line of credit or do a cash out refi. It's probably cheaper, but you won't build credit in the name of the business. And you also use up what I call some of your dry powder, which is your ability to tap cash later on if you need it. There's also potential for a 401k loan or a self-directed IRA. Your financial advisor would probably advise against this because it's the complete opposite of financial diversification. Maybe you can use some of those investments that you have to get a secured loan or margin account where you borrow against them. That's a good way to defer any capital gains tax that might otherwise be due when you sell a financial asset. Personal loans, this would also include credit cards. Again, it's going to be costly if you do something like this. And there are actually loan sharks. These people do exist. Again, they charge very high rates of interest, and depending upon who you borrow money from, it could potentially be harmful to your kneecap. So you might want to be careful about that. There are businesses that lend money to other businesses, and here are a few of them. So let's think about this. Where do you usually go when you need money, right? You go to the bank, right? When it comes to getting a loan for your startup business, here's the unfortunate reality. Okay, the bank's most likely not going to give you any money, at least not yet. You're too early in the process. You need to prove yourself before a bank's going to want to do business with you. So, but even though they're probably not going to give you money, you should talk to a bank anyway, and I'll tell you why in a little bit. If you are able, however, to qualify for any type of bank loan, by all means, you should probably take it, because the terms are going to be better than what anybody else is going to be able to offer you. So if you're a good customer of the bank, maybe you get a credit card. Remember, credit cards are only expensive if you carry a balance. If you pay off the balance at the end of each month, it's essentially a free loan. If you can't get money from a bank, then where do you go? I'm a little late on my timing here. Sorry about that. So there's a group of special lenders called not-for-profit economic development community lenders. They give loans to people who can't get a bank loan, and that probably includes all of you folks. So let me break this down for you. So not-for-profit means they're not looking to get rich from your business. If they're not looking to get rich, then what's their angle? They want to help your business succeed. And because they're essentially part of the government, they have the same objectives as the government, and they loan money to small businesses in their local community. Okay, there are several programs, federal loan programs that exist. The biggest is the Small Business Administration, which, by the way, scores part of the SBA if you didn't catch that earlier. The EDA sometimes has programs. CDFIs are special interest lenders focused on helping disadvantaged borrowers in disadvantaged communities. For example, women and minority-owned businesses in urban areas. As such, their underwriting standards and loan terms may be a bit more friendly, particularly for people with credit challenges. So if you fit into that group, that might be something worth checking out. Sometimes the state has programs for small businesses, and there's actually two right now that are in development, funded through the American Rescue Plan Act, ARPA, if you've heard of that, including the State Small Business Credit Initiative. And so information should hopefully be coming out on those two programs in the next few months. So stay tuned on those. And likewise, the local municipalities also have ARPA money that they have available. The city of Norwalk has a program that they're working on. It was supposed to be rolled out this spring through an organization called KIVA, K-I-V-A, that will provide interest-free loans between $1,000 and $15,000 to small businesses. So you can check that out whenever it does come out. Okay, this is important. The federal government doesn't make loans except for the SBA disaster loan. They guarantee them. Okay, government money is almost always, with very few exceptions, administered through third-party economic development lenders, which includes, these are the people you need to know about right here. Okay, CIC, by the way, is the company that I work for. So that's one of the three economic development lenders in the state that focus on loans for small businesses. Each of these groups have unique lending programs. Some are similar, so hopefully you can find something that works for you. Because their economic development lenders are all nonprofit organizations, we're more cooperative with one another than competitive. We each have different lending programs, so we regularly refer clients to one another, and sometimes we partner together on deals. So you'll find it's an interesting relationship. Again, there are very few options available for startup and fledgling businesses, which is why economic development lenders are considered to be the lenders of last resort. The SBA is the go-to resource for small business financing, so I'm going to spend a few minutes sharing information with you about the different types of SBA loans. Let's talk about microloans first. This is the most common loan for startup businesses. You can borrow up to $50,000 on a 5-year payback. The interest rate is fixed. The company I work for, CIC, does microloans at 7.75%. You can use the money for just about anything. The only thing you can't do with the money is buy real estate. Not that there's any real estate you can buy in Fairfield County for $50,000, so let's not worry about that. I mentioned previously that the SBA guarantees loans. They do, except for microloans. The way these loans work is that the community lender borrows money from the U.S. Treasury, and then we loan it to the small business. So we're on the hook for those loans. There is no SBA guarantee. So to minimize the risk, we provide a free service called technical assistance, which essentially means you get an experienced business advisor to help you with your business. That's what I do. That's my job at CIC. It's similar to the services of SCORE. In fact, I work in cooperation with SCORE mentors on a regular basis. At CIC, in addition to getting a business advisor, we provide help from I have a professional marketing agency that helps with developing your website and social media presence. This all is part of when you take out a microloan. And then we also have a QuickBooks Pro advisor to help you set up your bookkeeping, all paid for by a grant from the government through your tax dollars. Again, SCORE is also funded by the SBA. If you're a small business owner, you'll find that the SBA is your best friend. If you've heard the old saying, we're from the government and we're here to help you, well, in this case, it's actually true. Let me just say one more thing about microloans. If you meet certain qualifications like being in business for at least a year, CIC has a $15,000 micro now loan that you can get in about 2 weeks, which is nice. The most popular type of SBA loan is an SBA 7A loan. Banks are the primary issuers of 7A loans, but for a lot of businesses, particularly startups, they won't be able to qualify for a bank 7A because they can't yet meet the underwriting standards. So the SBA created a second type of SBA loan called a Community Advantage loan, which is available to B quality businesses that either get turned down by a bank or are very nicely discouraged from applying for a loan. CIC is the only economic development lender in the state of Connecticut that offers Community Advantage loans, so banks usually refer their disqualified borrowers directly to us. A bank 7A goes up to $5 million, but the Community Advantage 7A goes up to $350. These loans are typically used to finance tangible assets, including construction projects. So the loan term is a function of the useful life of the assets being purchased. We also use CA loans to finance the purchase of an existing business, which may be a better route to take than building the business from scratch, something to think about. The CA loan has a variable interest rate tied to prime. The current rate is the same as the SBA microloan. However, the microloan has a fixed interest rate. If you're concerned about interest rates rising even more, which you should be because they're going to, there was an article about that, rising interest rates in today's Wall Street Journal. Using a microloan for part of your financing package might be a good idea. You can combine the micro and CA programs, which means you can borrow up to a total of $400,000. The SBA guarantees a significant portion of the CA loan. Therefore, the SBA has to approve each deal, which adds a few weeks at least to the period of time it takes to get the money. So just keep that in mind. The SBA 504 program is used strictly for buying real estate. The nicest thing about these loans is the low down payment, which can be as low as 10%, and the low interest rate. The interest rate, by the way, has gone up by over 2 percentage points in the last 6 months because of rising interest rates in the market. The SBA essentially provides 40% of the loan at a fixed interest rate, and we get a bank to provide the other 50%, which usually has a variable rate. These loans are packaged into bond funds and sold to investors backed by the full faith and credit of the United States government, which is why the interest rate is so low. The bonds are usually bought by pension funds to provide an income stream for their widow and orphan clients, so they don't want you to pay the loan back early. If you do, they'll whack you for a point or two as a penalty. The prepayment penalty declines over time. Nevertheless, you should consider this type of loan a long-term financing vehicle. By the way, the other SBA loans I mentioned can be repaid without any penalty. In my opinion, the 504 is the best loan that the SBA offers. You might not need this right away, but I'm telling you about it because if you're eventually looking to purchase or finance real estate, 504 is the way to go. All of these loans are considered to be term loans, which means you receive a lump sum of money up front and you pay it back over a certain term. This is great if you need to buy something like an asset, but you can't afford to pay for it right away, such as a building, vehicle, or a piece of equipment. But what if you need money to pay for operating expenses? This is what's referred to as a working capital loan. You can use a term loan for working capital purposes, but it can be very expensive. Working capital needs are oftentimes short-term and they tend to ebb and flow. With a term loan, you're paying interest on the full amount of the loan, whether you use the money or not. Oftentimes, what businesses need to plug short-term gaps in their cash flow is a line of credit, which is a loan that you can periodically draw down as needed and pay it back over time. For instance, you need money to buy inventory at certain times of the year, and when you sell the products, you pay down the loan. This type of loan revolves, which means after you pay it down, you can borrow the money again. It works just like a credit card, same concept. The balance goes up and down depending upon how much of the credit line you're actually using. These loans are typically only available to established businesses that have a good relationship with their bank. For startups and fledgling businesses, the best you'll be able to do is get a credit card in the name of the business, which again works the same way as a line of credit. The interest rate will be higher than a commercial line of credit, but if you're only borrowing the money for a short period of time, which is what you should be doing with it, it's not going to cost you that much money. Again, access to capital is more important than the cost of capital. Don't get hung up on the interest rate if you're only using the money, say, for a few months at a time. Okay, when you need money, how much it costs is the third question you ask after how much can I borrow and how soon can you give it to me? The SBA is going to be coming out soon with a line of credit product through the Community Advantage program. Again, the CA program is for businesses that can't get money from a bank. If you need a line of credit and don't qualify for a bank product, the CA line of credit might be a good option for you. Qualification details for this program haven't been released yet, so stay tuned for more information about that. Okay, let's get back to the other sources of capital. So real quick, let's go through some of these. Dealer financing. If you need a vehicle, start with the dealer. Go there first. Ask them if they can finance it. There's usually the added incentive of making a sale, which is used to be meaningful, but with vehicles being so scarce nowadays, this probably isn't going to matter. This may or may not work for you, but I'm throwing it out there anyway. Leasing is similar to dealer financing. The difference is you're not building equity, which means leasing is going to be cheaper. You're just paying for the use of the vehicle, whatever it is you're going to be using. Remember, leasing is a form of financing. It works just like a loan. You have to make the payments no matter what. There are also fintech lenders. These are for-profit lenders, unlike nonprofit lenders like who I work for, and they're willing to take on more risk, so they charge you more, usually a lot more. Factoring is where you sell your future receivables or any contracts that you have and stuff. Oftentimes this is done by siphoning off credit card receipts. Your credit card processing company might hit you with a solicitation for something like that. It's like selling your blood. I don't recommend it. Crowdfunding can come in two forms. One, people give you money in exchange for free or discounted products or services. This comes with a high degree of accountability because there are orders that you eventually have to fill. And then there's also crowdfunding involving debt. Norwalk again has the ARPA program with Kiva that'll provide interest-free loans between $1,000 and $15,000 for small businesses. Check your local town; they may have similar programs. There's a lot of money floating out there right now, a lot. Grants are free money, which is the best kind of money. And I get asked this question a lot, so I'm going to spend a few minutes talking about it. Although CIC is affiliated with the federal government, we unfortunately do not offer any government grant programs. But some other lenders like Hedco, for instance, might, so shop around. In general, when it comes to grants, there's not that many around. They're hard to find. They're not easy to get. There's a process. It's like applying for a loan. And sometimes you have to document what you spend the money on. It's not really free because there's a high opportunity cost of your time. Guard your time, very carefully because you only have so much of it. They're oftentimes narrowly targeted to certain people in certain areas for certain purposes. And sometimes they require a percentage of matching funds. In other words, they'll give you part of the money for a project, and then you have to come up with the rest of it. WBDC, the Women's Business Development Council, they have a matching grant program underway for women-owned businesses that are launching new products where you can get up to $10,000. Check out their website for that. And then a group called CCAT, which is the Connecticut Center for Advanced Technology. They have a manufacturing grant program. One of my clients was able to take advantage of that. A word to the wise: beware of scams. Be careful about who you share your personal information with. Make sure it's a reputable outfit. And other sources that you can look at: some large corporations, FedEx, Amazon. They sometimes do grant programs. Private foundations like Hello Alice, banks occasionally. This one's interesting. Private benefactors. These are usually for social enterprises. So, this is important to get your story out, on social media in particular. I have two clients in the last year who received in the mail. Somebody mailed them each a $5,000 check, complete stranger who heard about their story and liked what they were doing and sent them free money. I kid you not, this actually happened to not one, but two of my clients. Business plan competitions. What SCORE is doing. Kathy spoke a few minutes ago about the program that we have underway right now. There are occasionally forgivable loans. You might be familiar with the Paycheck Protection Program. That program is no longer funded. It's been expired, but there are occasionally those programs that come about. Again, local municipalities have a lot of ARPA money. They may have some incentive programs. If you export a product, the SBA has some grants that can help you. And there are others. I mean, go online and research. The go-to resource is called GrantWatch, grantwatch.com, I believe it is, or org. I'm not sure which one, but and then also, get on the what is it, the SCORE email list. You're probably already on it. You probably get our emails all the time. I got an email this morning about a $25,000 grant from Progressive Insurance for Hispanic entrepreneurs who want to buy a commercial vehicle. So if that's you, you could potentially get $25,000 from Progressive Insurance. Okay, so after entrepreneurs use up their own funds and exhaust any grants, most people want to preserve their ownership percentage. So taking on debt is considered to be more attractive than giving away equity. So for the balance of our time today, I'm going to tell you the most important things you need to know about small business financing. Again, the SBA is the go-to resource for small business financing, so my comments will focus on how to obtain SBA financing products. If you're interested in learning more about alternative sources of capital, including equity financing, Cliff Enico is doing a SCORE presentation, a webinar on Tuesday, June 28th. Cliff is terrific. I'm sure his material will be very informative, so be sure to tune into that. If you miss it, you can find the recording on the Fairfield County SCORE website. Okay, so what are the qualifications for getting a loan? In order to get an SBA loan, you have to comply with the SBA rules. There are quite a few of them, including the business has to be small, as measured by annual revenue, number of employees, tangible net worth, and net after-tax income. I'm not giving you any of the numbers because the business can be quite large and still be considered small for the purpose of the SBA. So nobody is probably gonna have to worry about this, at least for the time being, not for many years to come. So let's not worry about that. But they do have certain requirements. There's also certain types of businesses they will lend to and certain that they won't. These are the types of businesses that can't get SBA loans. Okay, this includes buy and flip real estate speculation, strip joints, anything involving marijuana. Although Connecticut legalized THC last year, it's still federally illegal. Keep that in mind. These are federal loans, so they're subject to federal laws. There are other rules and requirements, which I'll touch on throughout the remainder of this presentation. At CIC, we use the SBA's underwriting standards for all of our loans. In addition to the SBA rules, lenders have their own unique requirements for borrowers. The other lending organizations I mentioned may have slightly different standards and processes, but they're all going to be substantially similar because we all follow the same rules. In order to get a loan, you have to follow the rules. Okay, here's a simple trick to help you get a loan. Reverse engineer the process. In other words, work backwards. Know what the lenders are interested in, and then figure out how to give them what they want. Again, the principles I'm going to share with you are pretty much universal throughout the entire lending world, whereby they apply to all types of loans to varying degrees. I call them the 7 C's of capital. The first is credit. Personal credit score for you, if you have a spouse. At CIC, we pull credit reports from 3 major reporting agencies, which includes Experian, Equifax, and TransUnion. We use a simple average from the 3 agencies for all owners who have at least a 20% interest in the business. Keep that in mind regarding your partnership structure. Ideally, your credit score should be at least 650, and the higher the better. Don't like to see delinquencies, bad debt write-offs, especially to the government, bankruptcies in the last 10 years. Those will hurt you. SBA loans require the borrower to seek what's called credit elsewhere, which means you have to be denied or discouraged. I touched on this earlier. This is why you should always talk with a bank before you seek SBA financing, because that can hold you up if you don't do that. The next is capacity. So you have to demonstrate to risk-averse bankers that you can afford the loan, right? You've got to be at or near the point of revenue, because 30 days after you get the money, you're gonna have to start paying it back. So I get a lot of calls from people who are not quite at the point where they can start paying the loan back, and so again I have to tell them, it's a little too early for you to seek a loan. In those cases, you're probably looking at equity financing if you need money. The capacity for the loan is they're going to look at your historical financials if they're available, or if you're a startup, they're going to look at your projections. This is where the financial projections and the business case qualitative analysis come into play. Household income is important. We want to make sure you can afford to live while you're building the business. We don't want to put you into poverty. Financial reserves. This is what I mentioned earlier about dry powder, having some backup money. Maybe like the home equity line of credit could be a good financial reserve that you could use for the business. And they don't like to see contingent liabilities like lawsuits, including divorce. That's stuff they don't like to see. Next is collateral. This is security in case of default. So this would be for the business and personal assets. These are secured loans. You're going to have to provide a personal guarantee. There's no such thing as limited liability when you borrow money. Same thing for a lease. They're going to want a personal guarantee. In some cases, on some loans, they might ask for a life insurance policy. They want to make sure that you stay alive. Next is character. Basically means you have to be a good person. So we look at, do a background check, criminal record. Be honest. If you have any issues in your past, it may not prevent you from getting a loan. We demand full disclosure and transparency. And what we don't like is we run a background check and we find out that there's something there and you didn't tell us about it. So just be upfront. I mean, they're very, very forgiving. The only things that would prevent you from getting a loan is any fraud convictions or crimes involving children. Speaking of children, if you have children, you got to be current on child support. Demonstrated humility is like, showing that you're not a know-it-all. It's like, hey, I've got a score advisor who's helping me. That sort of thing, I think, goes a long way toward showing that what sort of person you are. And references will be checked, by the way. Again, keep in mind, banking is a relationship business. It's based largely on trust. We like to give loans to people who we already know. Once we know you and have a relationship, you're more likely to come back and get loans in the future from us. Number 5 is commitment. There's a thing, what we call an equity injection. Think of it as like a down payment. You've got to be able to demonstrate that you've got some skin in the game. The lender's money is going to be the last money that goes in. You have to put your money in first. And again, we like to see effort. Show that you've done your research, your homework, the due diligence. The business case qualitative analysis is a great example of that. Demonstrates that you have done your homework on your business. If there's any grants that you applied for, that looks good. Make sure your documents are neat and clean. Just show that you're serious, right? Traditional banks look at the first 5 C's of capital. What makes economic development lenders unique is that they put more emphasis on the last 2 C's, starting with a compelling story. Kathy touched on this in her opening comments. There's an old saying, facts tell, stories sell, okay? This is where the business case qualitative analysis and for financial projections come in. They tell your story in absentia. You're not there to tell your story. The documents have to tell your story, and they both should tell the same story. One uses words, the other uses numbers, but they should tell the same story, okay? You want to also explain why the lender should give you money. Remember, their mission is economic development. So you have to, consider what's in it for them. This is important to keep in mind. Economic development lenders seek to finance businesses that will have a positive impact in their local community. Our mission is to make loans that are likely to result in job creation, development of new skills, construction, paying taxes, serving as a magnet or feeder for other businesses. We fund growth initiatives and business expansion opportunities, not distress, disaster, rescue, or bailout situations. At best, we'll fund a business turnaround with strong upside potential, but only if it's viable with a good story. We like to hear solutions, not problems. The presentation to the board for the loan approval is basically everything that you've submitted gets condensed down to a 5-minute story. And it's got to be good. Same thing with the business case qualitative analysis. You have 1 page to tell your story, same concept, okay? Number 7 is confidence. Confidence in the business and in the person, that's viability, and confidence in the person running the business, which is feasibility, okay? Keep in mind, the business itself is inanimate. We're loaning money to the person who will be running the business. In this race, we're betting on the jockey more so than the horse. So are you starting to see some of the connections to the business case qualitative analysis here? Part of what that document does is help to build lender confidence because it talks about viability. It addresses feasibility, right? It covers all these things. You should see a lot of overlap between these things as you're listening to this presentation and having already gone through that document. It should start to become clear here. Next is, resumes of the partners, track record of success, your history, that sort of stuff. Who's backing you? If you have other people who are backing you, who are equity owners or have loaned you money or whatever, that shows that they have confidence in you. And we like to see self-confidence, but again, it has to be realistic, genuine, and believable. Okay, so let's talk about the loan origination process. Government loans are all about the process, okay? So here's the process. Step 1 is where we go through and we collect a bunch of information. There is an initial screening interview that takes place with usually a loan officer. They'll ask you, questions. Do you have this? Do you have that? Things like that. A lot of forms to fill out, a lot of information to submit. They want to see your trailing profit and loss statement, balance sheet, taxes, leases. By the way, if you have a lease, the lease has to be at least as long as the loan, including any renewal option. You want to make sure that you're in control of the space for the period of the loan. Business plan and projections. Again, here we go with that. Everything has to function on a standalone basis. You don't want there to be any questions on the part of whoever is reviewing your material. Questions are bad because they create doubt, uncertainty, and even suspicion in the minds of the loan decision makers. So be sure to document everything. Step 2 is underwriting. This is also known as processing and credit. This is where the due diligence takes place as far as confirmation of all the information that you submitted. They'll do a background and credit check. Digital presence will also be checked to look at your online profile, website, social media, blogs, et cetera, vetting for the business for viability and feasibility. Again, here's the business case qualitative analysis again. They'll do an analysis on your projections to see if you can afford the loan. Did you use reasonable projections? Those sort of things. And then they'll do general reconciliation. Does everything make sense? Does it add up? Is there any discrepancies? By the way, if you have any undeclared income, cash that you didn't declare for taxes, that's the same as not having any income at all. We won't look at that when evaluating these loans. Risk mitigation is going to be the determination of how much collateral will be needed. Like I said previously, there might be insurance necessary. Depends on the loan. It's not always the case. And then again, this is where we start to build the business case, right? Figure out how to tell your story. Understand that the information we ask for is to help us tell your story. If you say, well, why do they need this information? Why do they need my resume? Well, because it's all going to become part of your story. Next step is approval. There's a number of people that have to approve the loan, starting with the loan officer, the credit review team, that's the whole underwriting group, senior management, and then the board of directors. The presentation of the business case by the loan officer is ultimately the approval that we need to get. They're your advocate, by the way. They carry your flag and they sell your story. So you'll get to know your loan officer very well. If your loan request gets denied, you have to wait a certain period of time before you can reapply. At CIC, you have to wait 6 months before you can apply again. So we want to make sure we get it right the first time. And then there's also SBA approval for if you have a community advantage or 504 loan. Knowing the SBA's standard operating procedures, the economic development lenders value added, this is why we're involved in the process. If the loan gets denied by the SBA, they issue what's called a screen out, which means you have to revise the package and resubmit it, which takes more time. Next step is closing. This is where more paperwork, form to sign. A lot of it's done electronically via DocuSign. You get the check cut, you get your money. The only thing I would say here is plan ahead. It can take 2 to 6 months. So start the application process, excuse me, as early as possible. I can't get you money yesterday. It's just not possible. Okay, so the last step is the post-closing loan servicing. So this is where the loan payment processing occurs, the accounting of it, if you will. Any updates to the credit bureaus, if you're on time or late, that gets reported. Statements, you'll get a monthly statement, you get an annual statement. There's certain things called loan covenants that are requirements other than making payments. So this would include things like they want to see your annual taxes, your profit and loss statement, and stuff like that. So the lender will continuously monitor the performance of your business. This is not really Big Brother. They want to help you succeed. So, if they're noticing that the business isn't doing well, they're going to try to help you out. Again, this is where the technical assistance comes in. If you have an SBA microloan, again, this is what I do. In addition, if you have Score Advisor and me, you can't have too many advisors. It's great. And then finally, there'll be a release on any liens on assets when the loan is paid in full. So that's the process. Here's 5 important things to keep in mind that you need to know about borrowing money. One is the second most common reason why new businesses fail is that they run out of money. The first reason is that their product or service wasn't viable, meaning the market was too small or too difficult to reach. Things always cost more and take longer than you expect. Time is money, so don't waste it. The longer it takes to get things done, the more money you're going to need, which leads me to the next point. Again, you need money in order to make money. And for most people, that means you're going to need to borrow money. Make sure you borrow enough. Once we do a loan, we can't go back and ask for more money later, unless the reason why the business needs more money is because performance exceeded the initial projections, which oftentimes is not the case. In fact, it's usually the complete opposite. More likely, the business failed to achieve the expected results. That's why the business needs more money. that sends a negative message, which is why they're not going to give you any more money. Again, we fund opportunities, not bailouts. Number three, these loans are not easy to get. They're not supposed to be. So you need to demonstrate that you're serious. Be sure you present your business well, polish everything up beforehand, really put your best foot forward. Defaulting, you don't want to default on this loan, okay, on any of these loans. This is where the business viability and feasibility comes into play. That's why I created that document, was to prevent business failures, okay? So borrowing money increases the risk factor associated with starting a business. Before you make the commitment, make sure you're confident you can pay back the money. Do your homework, okay? You don't want to default on a government loan. The SBA is part of the federal government, and their sister organization is the Internal Revenue Service, who are not the sort of people who you want chasing you for money. Let me just say one more time, it takes time to get a loan. There's a lot involved, so be sure to start the process early. Depending upon the type of loan you need, it can take 3 or 4 months, sometimes even longer, before you receive the money. With that in mind, there are certain things that you can do to prepare for taking out a loan. Some of these things take time and can slow down the process, so don't wait to get started. The more you can do up front, the smoother and quicker the process will go, and the sooner you'll be able to get the money you need. So what can you do to prepare for a loan before you apply? Here are 10 things you could consider doing right now. One, first order of business, this is the most important, is get your financial profile in order. Now, what exactly does that mean? Start with your credit score, okay? Again, try to get your FICO score over 650 at least, okay? Poor credit is the #1 reason why loans get denied. Maximizing your credit score is very important. If you need help in this regard, reach out to me and I'll send you a brochure I created with ideas for how to raise your credit score. Keep in mind, it can take several months before you'll see an improvement in your credit score, so you should start working on this right away if that's an issue for you. Any delinquencies or defaults, if you can't completely fix the problem, oftentimes that requires using scarce capital to pay back money you owed, but try to make arrangements to pay the money over time in exchange for the creditor removing the default. They might do that. So try to do that if you can. Very important to save money. You want to have at least 20% of the money that you need to borrow in reserve. Again, you need money in order to make money. So bank some coin if you can. If you have an existing business, you want to optimize your business financials for the last fiscal year at least. So what exactly does that mean? Maximize your revenue by collecting your receivables, economize your expenses, refinance high interest debt if you can, those sort of things, right? You want to demonstrate sophistication, particularly with your financial management skills. Successful business owners that I know where every dollar came from and where it went. You want to be perceived as one of those sort of people. I touched on this earlier. Think strategically about your business ownership structure. Anyone who's 20% more has a 20% or more greater equity interest in the business is considered to be an owner. We don't permit co-signers. You have to be an owner in order to be part of the loan equation. So that's important to know. Supplemental supporting income. Maybe you should consider keeping your day job while you build the business. This is a good way to keep money coming into your household. Like I said, we don't want you to be destitute while you're trying to build your business. Divorce is bad, especially bad for business. So if you're in the midst of that, try to wrap that up before you go shopping for money. Okay, number 2 is shop around, educate yourself, contact the economic development lenders to find out what types of loan programs they have available. See if there are any state or local programs available that you can take advantage of. Start a relationship with a bank, one that's likely to support you eventually. Think about what banking products you'll need and who's the best entity to provide them. Your business banking needs aren't always consistent with your personal banking needs, so keep that in mind. Talk to a commercial bank or credit union about giving you a loan. They'll probably say no, but a community lender will hopefully say yes. This will satisfy the credit elsewhere requirement. Okay, I jumped the gun a little bit on this one. So pull together the documents you'll need for the loan application. This is your taxes, business, personal financial statements, all that kind of stuff. Get everything organized so you're ready to go. If your business needs physical space, at least have a prospect identified, but if you can, wait to sign the lease or purchase and sale agreement. Try not to make any commitments until you're sure you'll have the money that you're going to need, okay? Define how much money you're going to need. Get written estimates for equipment, inventory, construction costs, that kind of thing. Here we go again. Get your business plan and financial projections done. You've heard me talk about the business case qualitative analysis and financial projections a lot. They're very important documents. By the way, do you see how all these principles work together? You notice how the business case qualitative analysis and for financial projections mirror the 7 C's of capital. Once you understand how everything works, you realize this process is not that difficult. It's really not. What I've done with this material is take seemingly difficult tasks and I made them simple for you. Writing a business plan and creating financial projections can take 5 months for some people to complete. I kid you not. With these templates I created for you, you can do it in 5 hours. Why did I do this? Because time is money. You got to get these things done as quickly as you possibly can. If you need additional help with these templates, score counselors are available to help you. Remember, you're in business for yourself, not by yourself. Do yourself a favor, take advantage of the free resources you have available. Technically, none of these services of the SBA are actually free. You've already paid for them in your taxes. Instead of saying they're free, we should say they're provided at no additional charge. You're paying for them anyway, so you might as well use them. Let's see, number 7, make sure your product service is ready to go to market. Again, 30 days after you get the loan, you have to start paying it back. So whatever upfront, whatever you need to do, previously to get into that point, get that done if you can. Number 8, your resume. You want to show that you've got relevant experience. So if you don't have relevant experience, or if you've got some gaps in that, consider taking on a partner or hiring a key employee if your skill set is lacking in any way. You don't need to rush into things like forming an LLC, setting up a bank account, website, social profile, all those sort of things. You can do those later. They're relatively, easy to do and can be done quickly at a later time. So just prioritize and focus on what's important for the time being, okay? However, if your business requires licensing or any certifications, those should be pursued in advance of applying for a loan. And again, this can take time. Government entities are understaffed and like everybody, and still haven't caught up from the COVID backlog. So allow a little extra time for any of that. Okay, so some of the items on this list will take time to complete, so you should start working on them as soon as it makes sense to do so. Remember, it'll take at least 3 months to get a loan from the time you have everything ready to present to the lender. Unrealistic timing objectives is the biggest frustrations that borrowers experience. I hear this all the time. I can't get you a loan yesterday. It's not possible. So be sure to plan ahead. So before we take your questions, I have a question for each of you. Did you learn anything new today? I hope you did. The purpose of this presentation was to raise your awareness of the small business financing process. Knowledge creates power. I've shared with you everything you need to know in order to get money for your business. Armed with this information, you'll be able to move through the process with more certainty and confidence. That's how you can contact me if you want to continue the discussion. And okay, so what questions do you have? This is my favorite part of the presentation. I want to hear from you folks. So type your questions or comments in the chat or message box, whatever we have there. Tim also asked me to address questions about the business case qualitative analysis. So if you have any of those, feel free to include those.
Okay, Joe, you're just going to jump in there and look at the chat. But in the meantime, I just want to jump in and ask you a question.
Sure.
You said that the lenders want some skin in the game. What kind of percentage are they typically looking for?
Typically it's going to be 20%. That's that equity
Okay.
injection, Kathy. That's what we refer to it as.
Okay.
So if you can demonstrate that you've got, now keep in mind, this doesn't necessarily mean you're going to put 20% in like today or tomorrow. It may be what you've already invested in the business. If you can document, that, let's say you look to borrow $10,000 and you can show that you've already put $2,000 of your money into the business, you're covered, you're good.
Can you borrow against your inventory or your receivables?
For the equity injection, you mean? Or just in general?
To secure the loan?
You can. I mean,
Okay.
you can borrow against. You can do a loan for the equity injection, provided that the cost of the loan payments, in other words, are included in the financial projections.
Okay, thank you. You also have one question in the Q&A. Do you want to just take the chats or?
Okay. Do you know what the banks require so that you can get credit card for your business, but without it being connected to your personal credit? I don't think you're going to avoid the personal credit thing. I just can't see, unless it's an established business that's been around for a while. It's any loan that you take out as a startup is going to be connected to your personal credit. So what banks require, what they require, They might not require as much as what it would take to get an SBA loan, but I'd say the biggest requirement is going to be your credit score. If you have good credit, they'll probably give you the credit card. And then what's the next one here? You mentioned your company helps with creating websites and tracking finances. Is that all offered to people interested in those services but not wanting a loan? Unfortunately, it's only available to people who have actually taken out an SBA microloan. So the answer to that is unfortunately no. Would be nice if it did, but but no, it doesn't. Okay, so let's scroll down here. Thank you, Mia. Excellent. Thank you, Jeff. Payment plan with the IRS for prior year personal tax liability. Would this have an adverse impact on securing a government-backed loan? I don't think it would, because you're in this case, this isn't considered a delinquency or default. I guess it's technically a delinquency, but you're in a workout situation. They would look at that as far as, the cost of that would factor into the financial equation. But this is a really good example of, like, this curing the sins of the past. I mean, you had a prior tax issue. You took steps to remedy it. They're not going to hold that against you. I mean, that's ultimately what we're talking about here. Let's see, Susan, how do you improve your credit score? Okay, so I did a one-page brochure on that. That, again, if you are interested in that information, send me an email to any of the email addresses you see up there, and I will send that to you. It's there's about 18 or 20 different ideas on there of things that you can do to hopefully improve your credit score. You can also hire a credit counselor. There's such people that exist that help you boost your credit score. You've got to pay them. And again, you need money to fix your credit problems. So this is usually not financially viable for a lot of people, but they do exist. How does a lender look at the change in career business that is totally unrelated to current new business? Transitioning from healthcare to become a residential contractor, newly licensed. Okay, so this is where relevant experience comes into play. If you can demonstrate that you have some experience doing whatever it is your business is doing, that would probably be adequate. Or if there's, sometimes one type of career lends itself well to other types of career. So let's see here, healthcare. I don't know what you did in healthcare, but, let's say if you were in nursing, for instance, and, you have a lot of contact with patients and stuff like that. You could say, well, you have good customer service skills, and which translate into the new business. So, you can work it that way, but sometimes what I tell people is if your resume is a little lacking in a particular area, let's say you want to open a coffee shop and you've never made coffee before. Well, you go work at Starbucks for 2 months, and then you can say you have experience. Those are the sort of things that you can fix those relatively quickly and easily. Okay, let's keep moving.
There's a bunch in the Q&A, Joe.
Yeah, I'm still looking here. Can you
Okay.
share info about DUNS for developing business credit? DUNS is that's Dun & Bradstreet. They issue a number to new business. When you get a new business, you get a DUNS number, and then they kind of work like the other credit agencies, Experience, Equifax, and TransUnion, and they all monitor your payment history and stuff like that. Equifax, TransUnion, and Experian, they mostly monitor your personal stuff. DUNS monitors the business spending activity, the credit activity of the business. So you'll find that the DUNS score is going to be different than the FICO scores, the personal credit scores. But here's the thing, when you're first starting out, your DUNS isn't going to show anything. So it's going to require a period of time before DUNS has enough data on you that they can actually issue an opinion on your credit worthiness. So it's that's why initially a lot of this is all going to come down to your personal credit. That's the go-to resource for information about your credit worthiness. So, but that's that's kind of what's involved with Dun & Bradstreet. It works very similar to the way that the personal credit does, but it just takes time to build that. One of the other things, not to use it as enticement, but that is an area that we're going to be doing more professional training on starting in July. I got another grant from the SBA to provide services for small businesses, educational services, and working on improving your personal and business credit is going to be one of the topics that we cover. I have a professional credit manager who is going to be helping us work with our loan clients. But again, you have to have a loan with CIC in order to take advantage of that. Can you use your EIN instead of personal credit? I'm not quite sure what that means. I mean, your EIN would be your identification number for your business. You can, if you have an existing business that has a track record of success. In other words, you know, you've got a trackable, you know, history with Dun and Bradstreet. So, you know, unless you have that, it's all going to come back to your personal credit. Anybody else?
Yep, Q&A. Look at the
Q&A?
Q&A. Yep.
Q&A. Oh, wow.
There's a couple in there, and then we have, it's 12:55.
All right, I'll hurry. Can you apply and build credit score? Yes, send me an email, I'll send you that. Identity theft, that's a problem. Will it prevent you from being approved for a loan? That'll be a problem, yeah. I don't even know how to address that one. That's a mess. Would a pitch deck be accepted in place of a business plan? Pitch decks are great. You know, the only thing with pitch decks is they're very promotional. And, you know, in this case, you want to be more informational than promotional, but potentially it depends on what's in there. Can you get a loan with bad credit? If you have bad credit, and if you're a women minority in an urban area, try to see the FIs first. They're the best place for you to start. Are you able to work with anyone not based in Connecticut? CIC is licensed in Connecticut and Rhode Island and parts of Massachusetts. Best credit reporting agency for business experience. They report on personal credit. Would they be a good choice for business? Again, we look at all three. So Experience, Equifax, and TransUnion. How can you find your credit status with Dun? I don't know how to do that. I mean, I know we have services where we can pull your Dun information. If you're an individual, I don't know how you would find that. I would start with calling them.
I'm going to jump in here. If you're already incorporated, they're already tracking you, whether you know it or not, and you can just be in touch with them directly, and they'll do it for you.
There you go.
Okay.
All right, all yours, Kathy.
Okay, Joe, thank you very much. I'm a little overwhelmed with all the information. It was fabulous. I want to thank everybody for coming. Our next webinar is going to be, it'll be next Wednesday. It'll be how to use a blog with Holly Hurd. So she'll be on at noon. So registration will be emailed to you, and we really want you to fill out the qualitative business case analysis. And if you need a mentor, go to our site and click the request mentor button. So for other information about SCORE webinars and workshops, please visit the calendar on our website at fairfieldcounty.score.org. And you'll receive an evaluation of this program today via email. We'd sure love you to tell us what you liked and what you didn't like. So on behalf of SCORE, I'd like to thank you for attending today's live webinar. I also needed to circle back with you. The business analysis are due June 29th. I had said previously the 28th. It is the 29th, and we'll be doing the judging somewhere around the 5th of July. So a big thank you to you, Joe McCaffrey, and also to our sponsor, Fairfield County Community Foundation. And thank you all for coming and for all your great questions. Bye now.
Sure. Thank you.